Hello everyone. I would like to review a trading book called Insiders by Superstocks. I have been a trader myself and I have gone through a wide variety of trading books, but there are a few trading books which are of real practical use, but they are not that well known. And they are also not that I would say systematic. But there are many useful things in such books because a lot of times such books tend to be written by practitioners who are actual market participants who have been keenly observing market for years. And same is the case with the author of this book called Jesse Stein. Jesse Stein has an impressive track record and he's a star trader. And after a long years of performing very well in the markets, he came up with this book. And I'll take you through a brief profile of Jesse here. Who is Jesse Stein? Why should I listen to him? Jesse Stein is a star trader who was able to turn 46,000 US dollars to 6.8 million dollars in a matter of 28 months. And it's not a joke achieving such a huge return. It's not going to be easy for anyone to do that. And even Jesse doesn't promise that reading his book you will achieve anywhere near his results. But one thing is very definite that he's very hardworking and dedicated, and you can see a lot of nuggets of your wisdom in his book. So, and his results are audited. That makes it all the more genuine. He's a U.S. resident who travels around the world, but I guess he is in the U.S. He started small and blew up his account many times. There are instances in the book where he talks about the blow ups in his account. He has had several blow-ups, uh, and at times up to 100%. And he has some unconventional trading strategies. He never recommends any consensus view. So there are many aspects of trading which will definitely make you wonder. And then his book is both motivational and has some key market observations. So you can treat it as a motivational book. If you're on the way to achieving financial freedom through trading, this book is definitely going to motivate you. And also there are a lot of things about the market which will amaze you, and there are many examples of the chart. I would like to review this book in a different way. Obviously this book deserves a full read, and there are significant chapters which require many reading in order to internalize his teachings. But I would try to give some of my key takeaways from this book. And I'm nowhere near his results or anything. I'm just on the learning path, and I'm hoping that by sharing, I'm internalizing my learnings and also my observational skills. Because market is a place where you have to be a lot observant, and there are times when you don't have to act or when you don't need to act, and there might be many reasons why you don't act at times. But you should never waste time. Even if you don't have money to invest, there is no harm in watching the market. It's going to teach you something, and you will have your day someday. So that is the reason I have embarked on this journey of reviewing trading books, whether I agree with their messages, and many of the aspects I may not agree, but I definitely, if I feel there is a book worth reviewing and bringing it to the public attention, I would definitely do that. Moving on, I would share my key takeaway number one from this book. So the key takeaway on for me would be embracing losses. So I have been a trader, and I have made a lot of mistakes in my early career, and I felt the embracing losses is a key message of the book. So he talks about a place in the book where he says that if you see any pattern breaking, do not hope, act. Sell first and ask questions later. So this saves a lot of money. At times when there is a scam which hits a company, many of us tend to kind of just freeze. We don't act. We just think that this is a market overreaction. Yes, it could be a market overreaction, but if it's a significant part of your portfolio, it would make sense to sell first and then ask questions later. So sell doesn't mean you completely get out of entire position. Sell means if you have a big position, trim it so that you are comfortable. So it's subjective, and it depends on your financial situation as well. So then there is also a lot of message about the mental aspects of trading in this book, but they are not actually structured in a single chapter. So they are spread across different chapters. So one of it is deal with losses unemotionally. Any trader would know that this would be easier said than done. If your losses are small, yeah, you have if you are a disciplined trader and you keep losses small, yeah, this may be easy to achieve. But on the other hand, if your losses are huge and they make a significant impact on your net worth, then I think it's difficult to be unemotional. But yeah, as traders, we have to learn and try to deal with the losses unemotionally and make small mistakes. So yeah, it's again to do with this part of embracing losses. Small mistakes are always cheaper. You make small mistakes and you win big. So that is the key message of many trading books. Same thing in this book as well. And now, one more thing is never add to a losing position. Yeah, if you are a value investor who is looking for something which is trading below liquidation value, yeah, you might add to a losing position. But even then, there are a lot of risks adding to a losing position. So, one important thing would be to have a rule that so I may not sell a losing position, but I will never average downwards. So, that could be another rule that could help us in some way. And then he talks about the fearless approach to trading. So, as you would have already understood, Jesse's trading style is a bit aggressive. It may not be suitable for everyone. He is a trader who kind of shifts his positions very quickly uh, and uh, and cuts the loss very quickly. Over the period of years, he would have learned that lesson. So that is another aspect of it. And then revenge trading should be avoided at all costs. So what is revenge trading? It's a very common term used among traders. Suppose I, as a trader, have a huge loss. Maybe I lose around 20% of my net worth in a single trade by not following my stop loss strategy or something of that sort. So I get really emotional at that time and I may enter into another trade to recoup these losses. So that is called revenge trades. So the second time when I entered in a position to recoup these losses, at that point of time my mind is not objective enough to assess the situation. So most of the times the revenge trades go bad. Very There are very few cases where revenge trades might work, but again there is more attributed to luck or chance, whatever you call it. So that is another part of this key takeaway. So moving on, there was another key takeaway. So I'll move to that. So second key takeaway is all stocks have different personalities. So what does it mean? We would have known that like you follow some 100-day moving average, 50-day moving average, and keep stop loss below that, these kind of things. But author talks about something called a magic line of a stock. So this requires a bit of understanding on technical analysis. So the magic line is something which the stock seems to be honoring again and again. So there might be many instances where the stock has touched this level, and then bounced back rapidly with higher volumes. So, and most of the times, the level seems to be a 10-week moving average, 10 weekly moving average. So that's what the author says. But I would say it could be different. So for one stock, it could be a 10 weekly moving average. For another stock, it could be a 5 weekly moving average. Even he says that, but in a different way. And there are also cases where a level, the actual number, the price of the stock also could be a magic line. So the it makes sense to study the chart patterns as deeply as possible. So that gives us enough confidence in entering into a position. And also it provides a very optimum low risk points. And again, though it's a well known thing, 50 and 100-day moving averages could be important levels. Like he says the same thing in the book, and even in my experience it's the same. Everyone knows it, maybe everyone follows it, that is the reason why it works. But yeah, 50 and 100-day moving averages are a must. But analyzing a particular stock's chart is of prime importance, is the key takeaway too. Then moving on to the takeaway 3.